Hey, I'm Steve from Quantamize. Is FOMO really driving the rally in US stocks? Or is it earnings? Let's find out together. Wall Street strategists are out arguing that the fear of missing out, or FOMO, is what's driving the rally in US stocks right now. We couldn't disagree more. Heading into 1Q earnings, estimates for 1Q had been cut from positive 2.8% to negative 4.1%. 2Q estimates have been cut from positive 3.3% to a little under 1%. That's a significant cut to estimates and would materially make the PE for the S&P 500 more inflated. Now, what am I talking about? PE is price over earnings. If the earnings estimate is decreasing, that forward multiple becomes higher, simply because the earnings estimate is lower. So what's the takeaway here? The takeaway is that the forward PE for the S&P 500 may be simply inflated, and that valuations are not that expensive because earnings estimates are too low. Right now, the S&P 500 is trading at roughly 16.8 times, and that's why some people are arguing that's expensive. But let's do an exercise here. Let's take that earnings estimate and increase it by 5% to adjust for Wall Street analysts being too pessimistic. The multiple for the S&P 500 suddenly becomes roughly 16 to 16.1 times, in line with its 5-year average. Now, that's not too expensive, is it? So what's the real takeaway? It's not FOMO that's driving the rally in US stocks. It's earnings, and focus on earnings when making decisions about whether or not you want to buy the S&P 500 or US stocks in general. Thanks for watching this video. Love to hear your take on FOMO and whether or not you agree with us. Subscribe to our YouTube channel, leave a comment below, shoot us a tweet, or send us an email. I'm Steve from Quantamize, and we've just been talking about whether or not FOMO is really driving the rally in US stocks.